Here is an example. Okay, Teltrex International can borrow $3 million at LIBOR plus a lending margin of 75 basis points per year, right? On a 3 months rollover basis from Barclays in London. Now suppose that 3 months LIBOR is currently 5.53%. Further, suppose that over the second 3 months interval, LIBOR falls to 5.12%. How much will Teltrex pay interest to Barclays over the next 6 month period for Eurodollar loans, right? So here's the idea, okay? The syndication loan, okay? Syndication loan. Here, the rate, borrowing rate, okay, cost of debt it would be, will be LIBOR plus X%, okay? Here in this example is plus 0.75% or 75 basis points, whichever way you want to call it. The thing is, if you look at it closely and remember what you did in your intermediate corporate finance class, what was your RD? You started with risk-free rate plus some risk premium. Make sense? Default spread kind of things, right? But if you look at this, you did not start with LIBOR. You did not start with risk-free rate. This LIBOR, is this risk-free rate? No, this is not. This is not. Okay? You will see LIBOR is not risk-free rate later on, but it's very close to it. Okay? Because we are talking about high-quality banks in London, British Bank Association groups, right? High-quality bank, but that's not still risk-free. Okay? The risk premium, a part of it is risk premium. And then here is another part of the risk premium. The thing is, industry convention worked in this way so that people have been using LIBOR as a benchmark plus some spread. Okay, we call it spread. Okay, loan spread. Okay, of 75 basis points or whatever basis points, assign it to the corporate borrowers. Okay. Now, how does this work? Well, starting from time point 0 when you started to lend your money. Okay. 3 months rollover, 3 months rollover, 3 months rollover basis. Okay, and then rollover, what do you mean? Rolling in the river, rolling over, right? Rolling over, which means your principal amount stay the same, but the interest changes because the interest is alive in the market, right? The living part is taken care of by this LIBOR. LIBOR fluctuates. The remaining spread, fixed, doesn't change. LIBOR changes so that the whole amount changes together with the LIBOR. The spread doesn't change. Okay? So that's how it goes. Now, let's see. Yes. All right. LIBOR is currently 5.53%, and then later on 5.12%, the second 3 months interval. How much will Teltrex pay in interest to Barclays over the 6 month period for the Eurodollar loan? Okay, here is the calculation. Remember, this is 3 months 3 months rollover. Every 3 months, the LIBOR rates at this point and that point. This is 5.53%. And that point is 5.12%, right? This point and that point. You just add the 75 basis points to the LIBOR rate. 75, 5.12 plus 0.75 percentage point, right? Each time point. and that stands for the next 3 months period. Okay, so that's that. One thing to remember is that you have to multiply it by 3 over 12, right? Because this is 3 months, right? 3 months interval, whereas your interest rate, LIBOR rate, is quoted at per annum basis, per year basis. So you have to multiply it by a quarter, right? A quarter? What do you mean quarter? Yeah, you see this, right? Cross it out for 1. Okay, a quarter. A quarter again. So $91.125 would be your answer to this question, right? Good. Forward rate arrangements is also there before we move on further, right? Interest rate risk, okay? The banks have to bear interest rate risk, okay? Interest rate risk. As your loan portfolios and then your borrowing, okay? Those two relations, your balance sheet, okay? If you look at the balance sheet of the bank, let me tell you about this using this balance sheet one more time. Okay, I think this picture was awesome. Okay, awesome. Let's see here. Let's see the balance sheet over here. Okay, can you see it? All right. I'll have to. Right. Asset and liabilities. Right. Asset, your investment portfolio. Let's say you have some lending or bond investment. Right. So lending or bond investment. Okay, sits over here with this huge balance sheet, right? It has some maturity in it, okay? Matures in some time, maybe in 6 months, maybe whatever months it may be. So you will receive the principal repayment in 6 months' time. On the right hand side of your balance sheet, you also have some bonds issued. Okay, don't get confused. This is a bond. Those two bonds are different. Okay, those two bonds are different. One, the bond over here. Let's say you're Bank of America. Okay, Bank of America. To do your banking business, you issue your bond in the name of Bank of America. It's like Bank of America's IOU to outside investors, maybe Warren Buffett or other kind of big investors. Oh, Warren Buffett, please put your money to our bank in the form of bonds. Okay, we're gonna repay you later. Okay, let's say this bond matures in 3 months. 3 months down the road, this guy matures. But if you look at this asset side, you have some bond investment to, let's say, ExxonMobil, our good old friend. You're Bank of America, but with the money that you got from these guys, either deposits, or bond investors, with this money you invested in ExxonMobil's bond. Okay, so this bond and that bond is different. Issuer is yourself, the issuer is ExxonMobil. The thing is, maturity is different. We call it maturity mismatch. It frequently happens. Unfortunately, it is maturing in 6 months. You can cash out 6 months. This one, you have to repay it in 3 months. Uh-oh, where would you get the cash to repay this guy? So that is a problem over here, maturity mismatch. Okay, or the other way around. You can think about it, okay? Or the other way around. Let's see. So interest rate risk that banks face, maturity mismatch between deposit and loan credit. We call it credit over there, loan credit, okay? Still the interest rate changes in the meantime, right? And the thing is, the big T is maturity, okay? So here is one situation. The first bullet point is that the maturity of deposit, which is the maturity of deposit over here, is longer than the maturity of your loan in your asset, okay? So in that case, right, if the interest rate falls in the market interest rate falls, right, soon what will you have? Well, the interest on your loan, okay, I should say it by the way, is 6 months and 3 months, okay? So loan matures in 3 months and 6 months, like this, right? So interest rate on loan will decrease while the deposit or your liability side interest rate will be fixed. It will be staying the same, okay? Maturity mismatch, if this happens, then your profitability, okay, your interest income minus interest expense will decline because your interest income will decline, okay? Well, we are assuming a kind of, what do you mean? After 3 months, we are rolling over, okay? We are rolling over after 3 months so that you will be applied with lower interest rate 3 months down the road, whereas your 6 months loan, your interest rate is fixed so that you will be squished, how do you say, pressured by in this interest margin, right? And so that's first bullet point. Second bullet point is the case when this guy is 6 months and this guy is 3 months, right? The other way around, okay? And then this is rolling over, okay? The thing is, your loan interest rate, let's say that stays the same because it's fixed interest contract, but in your liability side, the bond that you issued or deposit rate rises. Oh my God, you're squeezed again. This time your cost rises. So this is your profitability will decline. Okay, your spread, loan spread will decline. So you will have to manage your interest rate risk in respective situation. So forward rate agreement is there for you, okay, in the international banking market. The interbank contract, this is the interbank contract that involves two parties, buyers and sellers. The buyer agrees to pay the seller the increased interest cost in a notional amount if interest rates fall below an agreed rate. A seller agrees to pay the buyer the increased interest rate if interest rates increase above the agreed rate. Okay, so that's forward agreement. And then a forward rate agreement can be used to hedge assets that a bank currently owns against interest rate risk. For example, a bank that has made a 3 months Eurodollar loan against a offsetting 6 months Eurodollar deposit could protect itself by selling a 3-against-6 FRA for forward rate agreements. And they can also speculate on the future course of interest rates movement. And then forward rate agreement, here's an example, okay? So 3-against-9 FRA is a 3 months forward contract on a 6 months interest rate for a 6 months period beginning 3 months from now. Okay, you see the timeline over there. We are standing at 0 time point, and then 3 months down the road there is an agreement period, okay, of 3 months ending, and then the FRA period of 6 months is available for 6 months period starting from 3rd month all the way down to 9th month, right? and then there's a cash settlement of this forward rate agreement at the end of your third month, right? Now, let me take you to some the agreements. Yeah, profit and loss P&L diagram. Yeah, which is on your textbook page number 278. 278. Here you see forward rate agreement payoff profile, right? So what's on your horizontal axis is your settlement rate, okay? Your market rate, settlement rate, which is settlement of your contract of forward, right? 3 months down the road in the example before, right? The rate could go anywhere on this horizontal line as the market interest rate moves around, okay? And then what is the profitability, profit and loss of forward contract, right? Forward contract. Of course, when it is 0 over here, and then here is the what is that? The AR, right? Agreement rate. Wait a minute. If I label it, excuse me. Yeah. Okay. Right. Agreement rate AR, right? So this you can draw a 45 degrees line that's passing exactly this AR 45 degrees line minus AR over here, and then this should be the profit diagram for long position or buy, okay, or forward contract, okay. I should wipe this thing out. Buy, and I should write it this way. Short position or seller of the forward contract, okay. Their profit loss diagram looks like this, 45 degrees line negative, okay. So that's the profit and loss diagram, okay. And at the end of what's that, the settlement time point, okay, at the settlement time point, right, cash settlement time, what is the settlement rate? Depending on where you are, the profit and loss will be different, okay, like this. Right, now let's go through an more conceptual argument over here, and then numerical example will be following. At the end of the agreement period, the loser pays the winner an amount equal to the present value of the difference, between the settlement rate and the agreement rate, sized according to the length of the agreement period and the notational amount, right? It's a zero-sum game. Forward rate is like your gain is my loss, your loss is my gain kind of things, right? Buyer and seller's agreement. So what's the transaction amount that you have to, what's that, the profit, that kind of things that you have to, right? So at agreement period, the loser pays the winner the amount equal to the present value, okay? So what is the amount that you have to pay? The notional amount times settlement rate minus agreement rate times the days of the period divided by 360, which is following the bond market convention, and this is a present value, so you have to discount it at settlement rate times the number of days over the investment horizon afterwards. So the days means like this period, 6 months over there, FRA period. Okay. Now here's an example. Okay. So 5 million euro. Okay. And 4% rate, agreement rate. And then the 3 agreement rate, 4%. Okay. Say 4%. Okay. Right. This is a 3 against 9 FRA entered into January 1st, 2018. Has the following terms, right? So that's right. So January 1st, 3 months, and then after 3 months you have 6 months, right? 3 against 9. Okay, 3. Wait. 3 against 9. Okay, 3 against 9 FRA contract, and then let's say there are 184 days over this 6-month horizon. Okay, so this is going to be your numerator in your days calculation over 360. Payment happens over here. How much would you pay? The present value, okay, of the absolute difference, okay, coming from the AR versus SR, absolute value. Now on March 1st, if the actual rate is 4%, right? Actual rate is 4%. What's that? SR, right? Actual SR turns out to be 4%, exactly the same. Break even, okay? Nobody wins, nobody loses. On the other hand, if the SR is 5%, right? If SR is 5%, that's going to be over here, okay? So the seller, loser, pays the buyer how much? 24,918 euros, right? To the 24,918 euros to the long holders or buyers, right? How do you calculate this guy? Well, the next page, right? So the next page, right? So it is calculated following the formula. It's just the absolute value because the SR is bigger than AR, right? So settlement rate is 5%, right? Settlement rate is 5%. Agreement rate is 4%, okay? And then multiplied by the fractional period, okay? And then get the present value at the SR rate, okay, settlement rate, okay? And because this is SR is the market rate that's going to hold, okay, going into the future. Now, if on March 1st the SR is 3%, the buyer pays the seller, on the other hand, if, okay, the settlement rate turns out to be over here, okay, the buyer is a loser, you have to pay the seller. How much? 25,169 euros, right? So that's something you would be able to calculate at that point. Because this is the absolute value, you have to switch these two, okay, SR, AR, you have to switch these two. Now, proof of FRA utility as a hedge. This forward rate agreement is a hedging tool so that you will have stable return of 4%, guaranteed 4% return if you use forward rate. Okay, FRAs are designed so the buyer will have the same future value of interest expense, a perfect hedge at the agreed upon rate for any value of LIBOR at the maturity of the FRA. Now calculate the future value of interest expense. So whatever you calculate the future value of interest rate. If LIBOR at expiration is 3%, right? 3%. Then what do? Well, here is your euro amount. Remember, at the 3% rate SR, you had to you're getting the 25,169 euro in your previous calculation 25,169, right? 25,169 over here, right? So that was the gain that you're going to get. And then plus the principal amount of 5 million, right? And then what's the future value of it using your SRs, the settlement rate going into the 6-month horizon. That's your left-hand side calculation. That's this guy. And then if you calculate 5 million euros, right, at that secured 4% rate, right, 4% rate over the next 6-month horizon, then what you're going to get is the right-hand side amount, 5.1 million euros, right, which should be identical to the future value that you get using this. Okay, so that's one thing. And then mathematical notation looks like this, and then you will see that in any case you will get notional amount times 1 plus AR, okay, agreed upon rates over the days of the contract, like 6 months, right, in this case. Now the second slide over here, what if the LIBOR at expiration is 5%, right? 5%, then it's $5 million and then minus 24,918, right? Because you are the loser over there, you have to pay in 5% rate over here, okay? And then get the future value of it using the AR of 5%, and then that should be identical to $5 million, its future value using the forward rate of what? Agreed upon rate of 4%, right? So in any case, you will get 4% return, whether the settlement rate increases to 5% or decreases to 3%. Your risk, interest rate risk, is perfectly hedged to be 4% rate over here that you see. Okay, so that's the conceptual idea and represented in some numerical exercises. Now, so forward market, okay, is there to hedge your interest rate risk. And the euro notes are short-term notes underwritten by a group of international investment banks or international commercial banks, and then they are sold at a discount from face value and pay back the full face value at maturity. Maturity is typically 3 to 6 months, and then the euro notes, euro commercial papers, and euro whatever is there for you as an instrument, as instruments. The unsecured, this one, commercial paper, this is unsecured short-term promissory notes, in Korean terminology, 기업어음 kind of things, right? Issued by corporations and banks, right? 60 days, 30 days, commercial papers are there for you. Now, it's placed directly with the public through a dealer, and then maturities typically range from 1 month to 6 months. And euro commercial paper, while typically US dollar denominated, is often of lower quality than US commercial paper. As a result, it yields a higher rate. Okay. Now, Eurodollar interest rate futures contract is also available for you. Widely used future contract for hedging short-term US dollar interest rate risk. The underlying asset is a hypothetical $1 million 90-day Eurodollar deposit. The contract is cash settled, right? And then it's traded on the CME, Chicago Mercantile Exchange, and the Singapore International Monetary Exchange. And then the contract trades in March, June, September, and December cycle. Okay, 369, and 12 December, right? And then CME Group Eurodollar futures contract quotations are shown over here, right? And then Eurodollar $1 million unit, right? And then the points of 100%, right? Points of 100%, right? You can see that the table as an example now. And then CME Group Eurodollar futures contract quotations are shown also, right? Settlement, change in open interest, how many contracts are there, right? And volume, how many, contracts were, the open interest is like how many standing in a contract is there, right? The volume is like how many were transacted and made contract on that specific day. So that's that. LIBOR, that's something we need to discuss in the next section.